Alrighty, welcome back. In this video, we're going to look at taxes and the different types of taxes and the theories around uh, the way we do taxes. All right, and so just to get started, remember taxes are part of fiscal policy, and we can either raise or lower taxes. And there's two theories on how to charge for taxes, basically. And one is the ability to pay principle. Excuse me. And that just says that if you're making $5,000 a year in the U.S., you don't have any ability to really pay any taxes. All right, you'd be scraping by tremendously. If you're making $5 million, then you have a much greater ability to pay taxes, and so therefore you will be charged. All right, and so that's kind of what we do with income taxes. All right, and then we also look at the benefits received principle. All right, and this says that if you receive a benefit, then we're going to tax you for that government service that's provided to you. And so that would be stuff like, and the best example I can always think of is the gas tax. When you go to the gas station and you buy gasoline, there's a pretty decent federal tax on the gas. And they use this gas tax to build roads, build and maintain roads, and bridges and things like that. And so the idea is that if you use the roads a lot, you're buying a lot of gasoline, because remember, the government provides the roads for us. It's a public good. And so if you're using the roads a lot, then you're going to pay a lot of gas tax because you get a lot of benefit from it. If, let's say that you walk, you won't be paying any gas tax because you probably don't receive much benefit from the roads as much. So anyway, somebody like a trucker, they would pay a lot in gas taxes. Somebody who lived very close to where they worked or went to school, and that's all they drove, that they would pay a very small gas tax. But that's the idea of a benefits received principle. All right, so the people receiving the benefit from the government service are the ones that are paying for it. All right, so those are the two theories of taxation. Now, I want to get into the different types. We've got two different types of taxes. One is a direct tax, and the other is an indirect tax. So a direct tax is assessed, let's see, best way to put this. You don't have a choice as to whether to pay for it or not. So something like your income taxes, all right, that is a direct tax. It is taken out before you ever see it. So let's see, direct tax assessed, we'll just say on income. All right, not the best definition, but anyway, so direct tax, you don't have any choice. They take it out whether you like it or not. All right, an indirect tax is after the fact. So think of like a sales tax. All right. And so these are the two types of taxes that we have, a direct tax and indirect tax. This is not going to be as important, so don't stress on these, but the things to stress on, all right, are the different types of taxes, well, within these bands. So the first type of tax, this is a direct tax, is the progressive tax, a progressive tax. All right. So this is how we do income. This is our income tax in the U.S. All right. And so what this says is that as you make more money, so I'll just write it down, as income goes up, the rate at which you are taxed rises as well. All right, and so here's how it would look. So let's say that we have a person, we're going to put income here, and the percentage of the tax they pay here, and how much they had to pay out. All right, so let's just make a little table. So let's say that we have 4 different people. One person makes $10,000. Next person makes $25,000 per year. The next person makes $50,000. And the last person makes $100,000. All right, and so we know that with a progressive tax, the percentage paid the percentage is lower as your income's lower and goes up as your income goes up. And so I'm just going to make these numbers up. They're somewhat close to what it actually is in the U.S. But so 10% of $10,000, we'll say that they end up paying 0% taxes. All right, and again, this is the ability to pay principal. Let's say at 25,000, they might have to pay 10% of their income. At 50,000, they have to pay 25%, and at 100,000, they might have to pay 35%. And I can say that right now, currently, our top tax rate is 35% in the U.S. Obama is trying to change this and put it back up to 39, where it was when Clinton was president. But anyway, and one other random note, in 1959, our top tax rate was 91%, meaning if you made $1 million, you had to pay basically 910,000 of it. So, so let's look at what each person would pay. Now, this isn't exactly right. I'm trying to keep this part simple. What they really do is they say for your first 10,000, we don't charge you any percentage. For the next 15,000, going from 10 to 25, we're going to charge you 10%. The next 25, we're going to charge you 25%, and the next anything after that, 35%. So, but let's try and keep it simple. So, if you're paying 0% of your income, 0% tax, then you pay $0. All right, if you're paying 10%, if your income tax is 10%, then this person would pay $2,500. The next person would pay, if they 25% of 50,000 would be 12,500. All right, and then the last person, 35%, they would be paying 35,000. All right, and so not only does the money go up, but it goes up because the percentage is going up as well. So again, this isn't exactly right, but following the KISS principle. The KISS principle, we'll just go with it like this. So this is a progressive income tax. All right. Now, the other type of income tax, I think I may have, so it's progressive. Now we want to look at what they call a proportional tax. This is everyone basically pays the same rate. All right, and so let's look at our four people again. So we had the one person earning $10,000. Let's see, let's do this. So the income level here, percentage, and how much they paid. So $10,000, we had somebody making 25,000, 50,000, and 100,000. All right, and so let's say if this is a proportional tax, everybody's going to pay the same percentage. And so let's just say it's 20%, 20% there, 20% there, and 20% there. And so you can see that as you earn more money, you're going to pay more in taxes, but it's going to take the same chunk out of you as it does anybody else. And so let's say this person making 10,000, they would have to pay 2,000 in taxes. Person making 25,000 would be paying 5,000 in taxes. The person making 50,000 would be paying 10,000 in taxes, and the person making 100,000 would be paying 20,000 in taxes. And so there's debates as to whether this is more fair or not, because everybody gets hurt, if you will, the same, or whether this is a better system because as you earn more income, you have a greater ability to pay more. And so this person making 100,000 can give up 35% of their money, whereas this person making 25,000 can't afford to give up as much. And so, anyway, there's debates on the fairness of it and all that stuff, but I'm not going to have that debate here. All right. So those are the two types of direct taxes that we have, and those are proportional. And by the way, proportional is also called they call it a flat tax. So if you ever hear anybody talking about a flat tax, this is what they mean. All right. Now the last one that I want to talk about, and this is an indirect tax. And remember, indirect taxes, let's use sales tax. Remember, this is like an after the fact thing. So a sales tax would be an indirect tax. And they fall under indirect taxes are regressive. All right, there's a lot of different types of taxes out there, and they fall under this category of a regressive tax. All right, and so make sure this is our third one. We had, let me go back here, hang on just a second. That was number 2, and progressive was number 1. So the 3 big taxes to take out of this are progressive and proportional, and then a regressive tax. So let's look and see why they call it a regressive tax. Regressive tax takes a larger portion of low income earners total income. All right, so let's do a couple of math things, and hopefully it'll be very clear. So let's say that you have 2 people. So you got this person, and they make, let's see, how much? $40,000. So not bad. And then you have this person, and they're making $200,000. All right. And so let's say that they both decide that they want to buy a car, and they have similar tastes, and so they go and buy the same car. All right. And so let's say that the cost of this car was $20,000. All right. And in Georgia, where we're at, and a lot of other states, we have a sales tax of 7%. All right, so they both go and buy this $20,000 car, and we know that the sales tax is 7%, and so that comes up to $1,400. So each of these people have to pay $1,400. And so the question is, what percentage is 1,400 of this person over here, and what percentage of 1,400 is the percentage of their total income? And so when you work this out, this $1,400 becomes 3.5% of their total income. And so that's a decent chunk. And when you work it out over here, this 1,400 is only 0.7% of this person's income. And so would you say, and this brings up fairness issues again, is this fair that this person making 40,000 has to pay 3.5% of their total income in tax, while this person making 200,000 only has to pay 0.7% of their income for this tax? All right, so that's why they call it a regressive tax. And so this person might become a little more sad. All right, now the other tax that I want to show you that's a regressive tax is, so regressive is Social Security. Everybody's got to pay it. All right, so it is a direct tax. They take it out of your paycheck. And so here's how the Social Security system works. All right, and let's take these 2 people again. All right, the person there, they're earning $40,000, and this person over here, they're earning $200,000. So what the Social Security tax does, and by the way, Social Security is simply when you reach retirement, you've been paying money into the system through your Social Security taxes, and once you hit retirement, you start to collect some of that money back. And so it was meant as a supplement to your retirement account. So it's tough to live on Social Security when you retire if that's all you've got. People do it. But anyway, it was never meant for a retirement fund. So anyway, let's go back to these 2 people. So we got 40,000, 100,000. So what the Social Security system does is they take 6.2% of your income up to, and this is current from 2012, up to $110,100. And so if you're earning below 110, then you're paying 6.2% of your income. All right, and so if this person over here, they're earning 200,000, the Social Security tax says on your first 110,000, we're going to charge you 6.2%, but on the other 90,000, we're not going to charge you anything. All right, and so let's look and see what happens to the taxes that these 2 pay and why this is considered a regressive tax. All right, so I'm going a little bit long. This is the last thing. So Social Security tax. So this person would pay, all right, well, they have to pay 6.2% of 40,000, so that's $2,480, all right, which is 6.2% of their income. All right, this person over here, remember, they're being taxed on the first 110,000, and so if you take 6.2% of 110,000, they are paying $6,826.20. All right, but when you say what percentage is this of their income, then it gets to 3.4%. All right, and so in terms of Social Security tax, they're paying a smaller percentage of their income than the person making 40,000. All right, and so while these might be good things, the Social Security tax, if again a debatable question whether this is a good idea or not, but generally we've decided that Social Security is a good thing, and so this person over here is if you're earning less, you have to pay a higher percentage of your income than if you're earning more. All right, and so this is why we would consider this a regressive tax as well. All right, so that's it for the taxes. Remember, regressive, proportional, and progressive taxes. Those are the three that you must know. The EOCT likes these questions a lot. So anyway, till next time.